my channel. Today we'll be doing a deep dive into Brookfield Corporation. So we'll be looking at the corporation, looking at what the corporation does, their various businesses. We'll do a deep dive into their corporate profile, and then we'll look at some short clips from an interview their CEO Bruce FLATT had on Bloomberg. So without further ado, let's go and check out Brookfield Corp. So what does Brookfield Corporation do? Well, they are an alternative asset manager. So before we go ahead and look at the corporation, we need to look at what an alternative asset is. So I'm just here on Investopedia. So an alternative investment or alternative assets are a financial asset that does not fit into the conventional equity, so that being stocks, income, such as fixed income or bonds, or cash categories. So an alternative investment is not any stocks, not fixed income, and is not cash. So private equity or venture capital, hedge funds, real property, commodities, tangible assets are all examples of alternative investments. So an easier way to say this that they have here in their last bullet point is common forms of alternative investments include real estate, so that's real property, commodities like gold and silver, you can have crypto in here, collectibles. There's a whole bunch of things that can be alternative investments. This basically alternative investments are anything that is not really the normal way of investing into stocks or bonds or cash. So you can have collectibles like baseball cards, Pokemon cards, real estate, various types of real estate, commercial, residential, multifamily, different commodities, gold, silver, copper, etc. So Brookfield actually is in this alternative investment space and alternative asset space, and they are a manager of these investments. So what I did was I went ahead and I think, yeah, that should be big enough. I made a organizational chart of Brookfield because the business is pretty complicated to understand for those people not versed in their business. So it's a lot easier, I figured, to just make a diagram, as I'm also a visual learner, and I think a lot of people watching this are as well. So here's Brookfield Corp. So this is the entire corporation, and it's kind of like a family where this could be the mother or father, and then it has like a bunch of children, and then each of these children is kind of the other businesses. So the corporation here is then split up into these other underlying businesses here. Now each of these percentages represents the stake that the corporation has in each of these individual businesses. So the corporation has a 75% stake in the Brookfield Asset Management, 27% stake in Infrastructure Partners, 48% stake in Renewable Partners, 65% stake in Business Partners, owns 100% of the property group and 100% of the reinsurance group as well. Now, all of these are publicly listed, so you can invest in all of them separately if you like those specific businesses more than owning the entire corporation, besides the property group. So the property group is private. You cannot purchase this on the stock market. It is a private company and held by Brookfield Corp entirely. So we're going to look at each of these individual businesses in a minute and see what they actually do when we check out their corporate overview. But what I've done is I separated it into the terms of operating business, AUM as percentage of fees, and float. So Brookfield calls these its operating businesses. Brookfield Corporation is an operator of these businesses. So the infrastructure partners, renewable partners, business partners, and property group. So the property group, that's your commercial real estate, malls, strip malls, offices, things like that. And then there's also some residential real estate in there as well. Business partners, that's their private equity credit group. Renewable partners, so that's where Brookfield invests or operates in renewable energy sources such as solar, wind power, etc. Infrastructure, so that's where Brookfield actually takes and invests into operating and running infrastructure. So they call it the kind of backbone of the economy, which it is. So that's things like railways, toll booths, data centers, hydroelectric dams. Like they're kind of in everything in infrastructure, and they've been growing pretty well as of lately. And it's a great business, as these are necessary needs for cities, governments, consumers, citizens. So it's a very interesting business, and we'll look at that in greater detail in a minute. Their asset management side, so this is kind of like the crown jewel, I think, of their corporation. They basically invest, take their own money as well as institutional money, but basically in here they take institutional money, so they're dealing with billions and billions of dollars or private investment funds, and then they invest into other specific investments, such as some of these projects, and they invest in these projects through the asset management side, and they earn fees as a result of managing those assets. So that's AUM, stands for assets under management, and then they collect a percentage of those fees as the investment grows and for the investment amounts. And this is a great business because a lot of these assets, they take a long time to generate, well, not generate cash flows, but to get up and running, and then they're kind of locked these investors in for very long periods, sometimes 10, 15, 20 years in these contracts that they make. And the returns are great for both the investor and the asset manager, but they're collecting a percentage of fees each year that this is going on. So it's a very great business. Now, the reinsurance business, so it's kind of a newer business for Brookfield. They've kind of gone on an acquisition spree, and they've kind of got all these agents and started this insurance business. And the insurance business is still fairly small, but it is set to grow very rapidly as they will continue to expand in this business and use their synergies across the other businesses to grow their reinsurance business. So if you're not familiar with insurance, they kind of get a float, and then they use this float to invest as they see fit. And Brookfield, based on history, I'm very, very confident that they will be able to continue to grow this business in line with their other businesses. So feel free to take a pause and take a screenshot of this chart if you get confused, and you can use it for reference later. I think it was a great tool that I put in here for understanding Brookfield and their corporation structure. So let's go and look at their corporate overview. So I just pulled this from the Brookfield site, and it's kind of just their corporate profile. So let's go and look through this. It's May 2023. So Brookfield Corporation, they own high quality businesses that compound in value and generate strong risk-adjusted returns across market cycles. So the ticker here is BN, and if you look at the footnotes, it trades on the New York Stock Exchange or the Toronto Stock Exchange. Now, the 20-year return, this is pretty incredible, has been about 20%. So if you look at the second footnote, it represents the total compounded return with dividends reinvested. So that's important, with dividends reinvested over the last 20 years. So 20% per year over the past 20 years. That's pretty incredible. And it's very hard to find companies that can grow this fast and give you this return in the market. And it's been pretty reliable as well. So that's very, very important to note. And we'll come back to that later as well. Distributable earnings. So this is one of their performance metrics. So they measure distributable earnings per share as a key performance metric, and that's at $3.25. And that's been distributable earnings per share over the last 12 months, ended in March 2023. So what they're targeting here is a 20% plus annual earnings growth over the next 5 years. So that's over the next 5 years. That is pretty incredible to target that, and not only target 20% annual earnings growth, but to communicate that to investors. So they're actually that confident that they're letting us know that they will be targeting 20% plus annual earnings growth over the next 5 years. Putting that in writing and communicating that to investors, not a lot of companies will do that. So that right there represents or shows their commitment to returning shareholder appreciation, capital appreciation, and dividends, as well as this annual earnings growth to investors. So it's very important and great to see from a company. Then they are saying that they will target 15% over the long term. So that right there tells you that they're thinking, 5 years isn't the long term. That's actually short for them. They're thinking in terms of decades, 10, 15, 20 years, and they're targeting 15% returns over that long term, which is super great. And considering they've done 20% over the past 20 years, I would be inclined to believe that they can achieve 15% over the long term per year. So a perpetual capital base of over 135 billion plus a $40 billion insurance float. So we looked at the float. They have capital deployed across a diversified portfolio of high quality businesses encompassing asset management, the insurance, renewable power and transition, infrastructure, private equity, and real estate. So they've got their hands in basically everything in the economy in the alternative asset space. So strong record of deploying capital and building market-leading businesses to supplement returns. Conservative capitalization with significant liquidity to accelerate growth. So they're saying they have a lot of investable cash or a lot of liquidity to accelerate the growth that they foresee here at 15% over the long term. So their objective to deliver compound annual returns of 15% plus to shareholders over the long term. So that's what we looked at. How are they going to achieve this? They have stable and growing cash flows. They generate an annual generate annual free cash flow of $5 billion, growing at 15% plus per year. They have a strong record of delivering compound returns. They enhance those returns by investing free cash flows and recycling capital. Conservatively financed. They maintain a conservative balance sheet and significant liquidity. So we'll dive into this a little bit later too, but conservatively financed, they actually finance their assets like their real estate and things like that on a non-recourse basis, meaning that the debt is not held against the corporation. It's actually just held against that asset. So that protects the corporation in that respect. Competitive advantages, they're global. Just because they're global, they're not all over the place, but they're in 30 plus countries. And they actually have a very unique process in choosing these countries based on geopolitical aspects, how well government policies are, monetary policies are, in order for them to facilitate their growth and in order to do business. They choose their countries very carefully. So how they create value, they participate in increases in free cash flow and capital appreciation of their businesses. They allocate those free cash flows and they enhance value by two aspects. So the main one right here, number one, is their businesses. So they have their asset management business, which they collect fees on for assets that they manage. They have their insurance solutions which they've rolled out, and their 4 operating businesses, which we looked at before: the renewables, the infrastructure, the private equity, and then the real estate. So this generates about $4 billion annually in distributed earnings. This has compounded, or they're saying it's going to compound for the next 5 years at 20% per year. And they're targeting a total return anywhere of 12 to 15%. So that is super great. The second way that they, enhance or create value is capital allocation. So that's allocating the excess cash flow that they have and recycling capital. So they're going to allocate the excess cash flow, which we will look at their capital allocation strategy a little bit later. And then recycling capital, they basically, what Brookfield does is they look for undervalued assets. So for an example, if they look at a building and the building is, not in the best shape, or they can get a deal on the building, they'll buy that building and then they'll put a significant investment to it, fix it up, make it a lot better. And by that, they will have increased the appreciation or the value of that building. And then they'll decide if they will recycle it, meaning sell it for higher than they invested into and originally purchased, so making a gain on that sale, or they might just keep it and add it to their portfolio. So that's when they state recycling capital. They're basically taking things that they can find for value price, fixing them up and making them better, and then gaining on the sale of that, or recycling the capital to get profits. So they got about $1 billion of that, and they're targeting a 15 to 20% total return. I'm more focused on this business portion because that I can reliably predict. The capital allocation is a little up and down, but they're communicating that they're targeting a 15 to 20% return, so that could happen. Targeting growth in annual free cash flows of 20% plus on a compound annual basis over the next 5 years, and 15% over the long term. So we did see that. Now let's look at their businesses. So this feeds back into that, infographic that I made over here. So this is just going to explain each of these businesses and how they feed into the overall Brookfield Corporation. So Brookfield Corporation has about 135 billion plus of capital. Their asset management business has 83 billion. So they're a leading global alternative in the asset management business, and they collect management fees on this business. The insurance solutions, relatively new, has about 8 billion. They have, life annuity insurance, pension, risk transfer, property and casualty insurance. So all of the main types of insurance there. Their operating businesses, so those 4 businesses here, They are a portfolio of global scale operating champions, as they call them: renewable power and transition, infrastructure, private equity, and real estate. So for more information, we will look at Appendix A at the end of this presentation. So here's a nice infographic that they have, their business plans for their existing businesses to chart their annual DE, which is their distributable earnings growth of 20% from the end of 2022 all the way to 2027. So here we can see this blue color right here. That's their operating businesses. The green color being their asset management business. And then this other light blue color right here being their insurance solutions. So they're projecting 20% compound annual growth rate over the next 5 years, going from 3.7 billion in annual distributable earnings all the way up to 9.3 billion. So that's pretty great to communicate to investors. And I have no reason to believe why they can't do this, because they've been doing this for 20 years. So it's a very nice, easy to follow infographic here, and definitely check it out. And as you can see, the asset management business is, in my opinion, their crown jewel, because it's a very great business. They just collect fees on managing assets, and it's a very high margin business as well. So we'll be looking at the asset management business first. Like we said, they're a leading global alternative asset manager with over 825 billion of assets under management and over 400 billion of fee-bearing capital. So they've highlighted this year, they've got 83 billion of capital, and Brookfield, like we saw, 75% interest in the Brookfield asset management. So the corp has 75% interest here in the asset management business. And that results in 2.5 billion of annualized distributable earnings. So it's one of the largest global alternative investment businesses with diversified offerings across the renewable power transition, infrastructure, private equity, real estate, and credit. Strong investment track record, that's true. They are well positioned around the global secular tailwinds of capital deployment, strong annual growth profile of 15 to 20% per year. Now remember, this isn't a tech company. This is a alternative asset manager. So to be getting these type of growth rates, that's pretty incredible. Now they have diverse and resilient cash flows. They have best in line long-term annuity-like revenues. So when they mean annuity-like, that's what I was speaking to before. A lot of these asset management, agreements, they are for, decades. Some are for 10 years, 15 years, 20 years. So they kind of are saying that they have these long-term annuity-like revenues because they'll be getting revenue off of those investments from institutional and private clients for managing those funds for a long time. So this allows them to predict their cash flows very, very reliably. So robust liquidity position to support inorganic growth initiatives. So that's very great to see as well. So here's a breakdown of their asset management business. They invest in high quality essential assets and businesses that form the backbone of the global economy. So they're saying here that their fee-bearing capital, which is 432 billion, so that's the amount they can collect fees on, fee-bearing capital. It's split up into these categories: renewable power and transition, so 53 billion, infrastructure 93 billion, private equity 39 billion, real estate 98 billion, credit and other 149 billion. So it's very diversified, and it is the backbone of the economy. So we need power transition, we need infrastructure in order for cities to function, private equity, we need real estate, and credit and other. Scroll down. So here's their asset management business. Like we saw, 75% of the corporation, or 75% interest is what the corporation owns in BAM, Brookfield Asset Management. Value is created by increasing that fee-bearing capital, so increasing that AUM, and then they can charge or get higher revenues from that AUM or a higher revenue. They maintain cost discipline, so they're being careful not to increase those costs at a high rate, and that will keep their net or their distributable earnings higher, and they are achieving strong investment returns and performance. Their key performance metrics here, so distributable earnings, that's their fee-related earnings, so that's their main one. Fee-bearing capital, and then some carried interest as well. So how they measure value, you can read this. It's kind of just how they internally measure value, so the market price of BAM, and they take it as a multiple of the fee-related earnings. So this is how they actually measure value, not how the stock market measures value. So their insurance business, relatively new, but they're a leading provider of capital-based solutions for the insurance industry. And here we have a snippet as well. So they have about 40 billion of investment assets, 8 billion in capital, and it results to about 700 million in distributable earnings. So they have an experienced team of 4,000 insurance investment professionals, low risk insurances with a strong investment track record. They have relatively liquid and short duration investment portfolio, which is great because that keeps them in line with their growth trajectory as they deploy capital. And they're trying to achieve significant synergies with the other Brookfield, corporations and their access to capital to other investors, and leverage those relationships to achieve their insurance business growth of achieving 15+% returns on equity. So they fully own this insurance or reinsurance business. Value is created kind of in the same way as the other asset management business, but they will have to manage their risk. That's, insurance contracts are risky, but if managed correctly, they are kind of a cash cow. And then they want to earn attractive risk adjusted returns on those insurance assets. So they're operating businesses. So these are the largest pool of alternative assets invested in 4 global operating businesses. So those four global champions, as they state here, got about 45 billion in capital, which equates to about 1.5 billion in distributable earnings. So these 4 global champions, they operate a portfolio of irreplaceable real assets that help form the backbone of the global economy. So these 4 champions are renewable power and transition, infrastructure, private equity, and real estate. So they generate stable and predictable dividends that are underpinned by growing and recurring inflation-linked cash flows. So this is very important to understand. A lot of these businesses like real estate, infrastructure, when inflation kind of goes high, it sometimes helps these businesses because the cost of building, additional real estate has gone up. So to build real estate, so these assets that they own, the value of those assets does go up over time as well. But there is an inverse relationship with interest rates, so it is a little sensitive in that area. But they are generally very good to hold in inflationary environments. So they deliver strong risk-adjusted returns across market cycles. They provide transparent financial results and market pricing. A significant portion of the business is held in publicly traded investments, so you can go and look at each of these global champions. Finance conservatively with asset-level debt that has only recourse to the asset and no cross-collateralization. So their operating businesses, it's what they own. 4 market-leading operating businesses with 45 billion of their capital invested across a pool of core inflation-linked real assets. So renewable power and transition, 10 billion. So that's hydro, wind, utilities, scale solar, some storage solutions as well. Infrastructure here, utilities, transport, midstream data centers. Private equity, 3 billion there. Business services, infrastructure services, industrials, residential, real estate. So they got 15 billion in what they call the core portfolio, and 10 billion in the transitional and development. So the core is usually what they're holding on for the long term. 10 billion is kind of that recycling that we looked at before, where they buy undervalued assets, they fix them up and they sell them for a profit, or they decide to keep them as well. So 10 billion is in there. This is split up into office, retail, single, and multifamily residential. So all of these have tickers, and you can invest in each of these individual companies as well. For me, I like to look at the corporation as a whole because it's owning a stake in all of these companies. So how value is created for these operating businesses, they increase their cash income by their operating businesses and capital appreciation via operational improvements. They focus on maximizing their efficiencies and productivity and executing those value creating development and capital projects. And they have a disciplined recycling process of those underlying assets. So buying those undervalued properties, fixing them up, or undervalued assets, fixing them up, and making their use or their life a lot longer, and then therefore maybe will keep those assets or they will recycle them and sell them for a profit. So key performance metrics here, it's the distributions received from those operating businesses. So the distribution, so that's the cash flow that they get, the operating FFO or free funds of operations from their operating businesses, and the blended value. And they measure value again. You can look at the market prices of those stock tickers. But again, Brookfield Corp, they have their own internal calculations, and they know I trust their calculations a lot more than the open market because the market is volatile. It's subject to change or emotion. They kind of keep a very disciplined approach, and they know how each of their businesses should be valued. Capital allocation. So we said we will look at that This is the second part of the strategy. The first that we looked at was their operating businesses. But they're saying their businesses should generate significant free cash flow. So if they achieve their plan, they expect to generate $3 billion of free cash flow over the next 5 years. So here we can see that 35 billion kind of broken up into an infographic. So most of it coming from their operating businesses, probably to about 55% to 60%. Then the other 30 to 35% coming from the asset management side. And then the other 10 to 15% coming from the insurance solutions. So it is growing a lot over time. So capital recycling, this is what we talked about. So they plan to recycle $10 billion of capital over the next 10 years from their real estate business into the broader franchise. So I'm just going to scroll back up and look at their real estate. So this is that 10 billion of transitional development and the 15 billion of core. So a 15 billion of core right here, they are going to hold because they believe it's a natural fit for their businesses, and it's maintaining an irreplaceable portfolio of trophy mixed use, offices and things like that, or retail. So they think that this actually, these properties, and they are great, they are their core. They want to hold these produce significant cash flows and appreciate well over time. They're being occupied and used very well. So they are very great assets to own and irreplaceable. A lot of these, like the Manhattan West, New York, they've doubled rent over the past 2 years, and people are paying because of where it is in New York. They have London's Canary Wharf. They have, gaming as well. So there's a lot of businesses here that they want to hold because they are in great locations, in great cities. They have a lot of great tenants, and they want to hold these assets because they produce significant free cash flow for them. Now the 10 billion here, so they have some that they want to monetize. So they maximize returns development through a buy, fix, and sell strategy. So they buy undervalued assets, fix them up, and sell them. Pretty straightforward. So they're probably going to use this capital, invest into these other businesses or into these other offices, make them even better, and then recycle this capital over time. So it's capital allocation strategy. We kind of just, really talked about this. They're just recycling this to sustain long-term growth and returns, and they allocate free cash flow to create value in many ways. So this is very important. They invest in or alongside their asset management business. I believe it's their crown jewel, and they see that, and they want to keep investing into that growth. They have further scale on their insurance solutions business, so they want to bump that business up fairly fast. Invest alongside their operating businesses in large strategic transactions. They want to retain excess capital to protect against downside risk. That's always good as a manager, to have excess capital to protect us shareholders and the business. And they want to buy back stock. So, I've heard various interviews of their CEO, Bruce FLATT. We'll see in a minute. But he feels Brookfield is very undervalued and has been prioritizing buying back stock. So this is one of their key communications that has been to investors, that they will buy back stock when they feel it is undervalued. So capital allocation, it could meaningfully add to our 5-year growth in distributable earnings. So this is their base plan that we looked at before, that 3.7 billion, in 2022, growing up to 9.3 billion at a 20% compound annual growth rate per year. So this is the core businesses right now. So what they're saying is, as of the impact of capital allocation, which we just saw here, so this capital allocation strategy of investing further into their businesses, using those free cash flows, investing into their asset management business, insurance business, buying back stock, etc. So they actually believe that that could increase this compound annual growth rate to 28% per year over the next 5 years. So the total impact of this capital allocation will be this additional 3.3 billion right here. So this could be their 2027 distributable earnings number. So instead of 9.3 billion, it could be 12.6 billion. This to me is a little aggressive in terms of me being able to reliably predict what will happen. So this is it's like a cherry on top, but I'm still more inclined to believe this base case here, which is still great at 20% per year, because this is their core businesses. They have a very strong hold on these strong knowledge of these businesses and their direction they're headed in. So this kind of me seems to like the base case, and this would be like the total optimist case. So I kind of believe this right here, but it's also nice to see that they're taking into consideration the impact of their capital allocation and how it possibly could benefit me as a shareholder. Capital allocation, so how value is created and measured. So we saw this, they want to have a priority now of increasing cash dividends to BN shareholders. So that's Brookfield Corp shareholders. So they're communicating that they want to increase these cash dividends. They want to have accretive share buybacks. So the keyword here being accretive. A lot of companies will buy back shares when they're super expensive, using that cash flow kind of at the wrong time, because buying back shares that are super expensive, valuation doesn't always help the shareholder. Sure, it takes out shares out of the market, making you a larger equity holder, but they're not getting the best bang for their buck, if you will. So accretive means that they're buying back shares when they feel that they are undervalued. So supporting the growth of their businesses, new strategic investments, special dividends to BN shareholders. That's awesome that they're going to consider special dividends as well, as in addition to the increasing cash dividends or normally cash dividends here. So this is a very nice box. I would actually highlight this and keep this slide. It's all of the things I'd want to see in a company I invest in. So key performance metrics. Their key performance metric is really distributable earnings. They want to increase that over time, and thereby when they increase the distributable earnings or cash flow, they end up increasing the intrinsic value of Brookfield Corp. Okay, so scroll down. Again, we can see something under capitalization and strong liquidity. So they've got a minus corporate, debt rating, $5 billion in cash, financial assets. And this is just conservative capitalization, talking about their debt. So they've got $12 billion in long-term debt and $57 billion in perpetual equity. So that's great to see. Key takeaways. Again, they're communicating. They're gonna be well positioned to continue on this 15+% total returns for shareholders over the long term. So we've seen this all over the slide deck. So they are very adamant and very confident that they can deliver this to us as shareholders. Now, their businesses, they're poised to deliver these 15% plus earnings growth over the long term. Their asset management business is positioned for the next phase. Insurance solution businesses is growing very, very fast, and they believe it's going to be their next global champion. $45 billion of capital invested across their other four market-leading alternative operating asset management businesses, and those generate substantial free cash flows. Capital allocation we talked about before. And now this is kind of their capital. So you can take a screenshot. I'm not really going to go over this because we kind of already have. It's just annualizing their cash flow and their capital based on their percentage ownerships in each of the companies. So feel free to pause or take a screenshot and look at that on your own time. Their operating businesses. So this is just summarizing this appendix, what each of those businesses is and the percentages that they own. They own roughly 50% of the renewable partners. So they say roughly, go back to my slide. Yeah, I have about 48. So I took it from their actual statements. They're kind of just rounding up here in the slide. So it's pretty close. And they have best in-class assets here in major technologies, including hydro, wind, solar, storage, facilities in North America, South America, Europe, and Asia. It's diverse, high-quality cash flows, and it's integrated platforms on 4 continents. So here's $77 billion in AUM, or assets under management, $10 billion in capital, $412 million from this business in distributable earnings, and they're targeting 12 to 15% target returns from this business. Saying decarbonization will create an unparalleled commercial opportunity requiring 150 plus trillion over the next 3 decades. So that's focused on the growth and efforts of decarbonizing our planet. So if you look at infrastructure, you own 30% of this business. It's one of the world's largest operators of global critical infrastructure assets. So one of the few pure play publicly traded global infrastructure vehicles. So I have utilities, midstream, transport, data operations, stable cash flows, high margins, and strong internal growth prospects. 161 billion of AUM here, 7 billion of capital, 320 million in distributable earnings, 12 to 15% target returns. So the infrastructure super cycle is continuing to play out as they expect, driving outsized capital deployment opportunities for our future infrastructure business going forward. And he talks about that in the interview, and we will look at that in a minute. Private equity, so they own 65% of Brookfield Business Partners, a leading private equity investor that owns and operates high quality businesses globally. So again, they've got 139 billion here in AUM, 3 billion in capital, a little bit smaller in distributable earnings here, 36 million, still targeting 15 to 20% target returns here. So real estate, they own 100% of this property group. And again, this is the only one that is private. You cannot buy this one outright. One of the largest owners and operators of iconic properties in the world's most dynamic markets. So they have diversified global portfolio spanning multiple asset classes, including office, retail, single and multifamily residential. So when people have heard about the real estate, they've heard about some of the bankruptcies or things like that where they haven't made their mortgage payments. That was only for like a small portion of the real estate portfolio. I think it was like 1%. So it's super small. They kind of let those go on purpose, I believe. And a lot of that debt doesn't flow back to the corporation. It just goes against those assets. So they're kind of getting rid of the, let's call them not so great assets, and they're focusing on enhancing or getting even better assets. So I really like that focus. 270 billion here in AUM, 15 billion core capital, 10 billion in transitional development capital, 769 million distributable earnings, and 10% target returns here. Again, they're just showing this slide again. They have an irreplaceable core portfolio of trophy mixed use precincts in global gateway cities and transitional and development portfolio designed to enhance returns. So they're keeping this core portfolio, which I like, and then they're deciding which ones they'll buy or get rid of or etc. So again, that was their slide. So let's go and hope that provided value to you. So let's go and look at their actual video, this interview that I wanted to watch. I'm going to just be showing it on YouTube here, and we'll be looking at it now.
Anything that has a Brookfield in front of it, you should invest in. It's not always about finance. It's about running businesses. If you've been around for 30 years with us, you've made a lot of money.
Even if you don't know Brookfield, one of the largest investment firms in the world, you know its portfolio. London's Canary Wharf, the Atlantis Resort in the Bahamas, 229 hydroelectric plants in North and South America, and enough fiber optic cable to wrap halfway around the world. With all that, Brookfield still manages to fly below the radar.
We've always just been a little more low profile, which is not good or bad, it's just a little different.
Brookfield emerged from a Canadian industrial conglomerate to become a $700 billion powerhouse in real estate, renewables, and infrastructure.
We had our own money invested in our own businesses, and over time we figured out which ones we liked. And then we raised money around those businesses.
Brookfield's heads down, no frills approach is very much a mirror of its leader, Bruce Flatt. He's the very opposite of the swashbuckling Wall Street characters often associated with real estate and private equity.
Patience, discipline, and the learnings of compound return have been an amazing thing that we benefited from.
If you had invested in Brookfield when Flatt took over as CEO 20 years ago, you would have had a compounded rate of return of 20% a year. But Flatt won't take the credit for that.
I didn't build this. My partners and I built it, and the other 2,000 people built it.
All right, so that was Bruce Flatt. He's kind of showing, the intro to Brookfield, and we have David Rubenstein here doing the interview with him. So that was just an introduction to Brookfield and kind of what they do. So I'm shooting this all live, so there might be like a commercial or two in here. You can just totally skip forward ahead to that part. But that's kind of an introduction to Bruce Flatt, their CEO. So we're going to go and look at it as him talking to him.
So you are running one of the largest private investment firms in the world, but to be honest, Brookfield isn't as well known as some of the firms that are competitors that are smaller than you. I mean, you're much bigger than Apollo, you're bigger than KKR, you're bigger than Carlyle. So how come you're not as well known as some of the firms I just mentioned?
We just always focused on on the clients, and we focused on our shareholders, and the culture, I guess, was just to do that. And the upshot of that is what it is. So we've always just been a little more low profile, which is not good or bad. It's just a little different.
So
right there, that's great. That's what I want to touch on is he's saying that it's not good or bad. We've just always flown under the radar. So I like my investments not to be flashy. I don't want them in the news all the time. I want them to be subject to all this volatility and other investors' emotions. Being boring in investing is actually a very awesome and desirable trait, because when you're boring, you know the business, you can focus on the business, you don't have to hear all this other noise. When you're considered boring or not flashy, you're predictable and profitable. I like my management teams and the CEO here, Bruce Flatt, to emphasize and embody that thinking, because that's telling me they're thinking the same way that I am, and I would like to invest in this company. Okay, now we're going to go and look at this.
Educated as an accountant.
Yes.
Now, I have a high regard for accountants, particularly when tax season comes along. But how did an accountant become the head of this gigantic organization? What was the skill that you used to kind of go from being an accountant to running this entire large company?
So when we started, it wasn't so big. It was pretty little. And I would say by people we have, we just learned along the way. And we started investing. We were investing then, and we grew the business. And patience, discipline, and the learnings of compound return have been an amazing thing that we benefited from.
And
So right here, Bruce Flatt is an accountant. I'm an accountant, but learning accounting is super great for business aspects. You see kind of all of the business. You learn about the business from the revenue generation activities, the expenses that are incurred, the contracts when you're preparing these financials. You're consulted a lot upon management, for making business decisions, budgeting, proposals, and you can become a great business leader if you have the right temperament through accounting. So just wanted to highlight that as well. I'm going to go and look at the other clip.
Thing that we benefited from.
And you seem like a low-key guy, don't seem like a screamer or yeller. What happens if something goes wrong and you lose money on something? Do you yell and scream at people? Do you fire them, or do you have somebody else do that?
Look, I would say the culture of our place is try to make as many small mistakes as you possibly can, which means that you're testing the windows every day, but don't make any really large mistakes. So we try not to make big mistakes, and but the little mistakes we make all the time. And so people are encouraged to make small mistakes, and that's a good thing. And because it means that we're testing the limits of where we should be going.
Have you ever made a big mistake that really hurt this company, or you haven't had that in 30 years or so?
Look, we've made lots of little mistakes, but you can't compound at 17% for 30 years or 20% annualized for 20 years and make any big mistakes. It's impossible.
So right there, I love that mantra, making small mistakes, not big mistakes. So they're encouraging a lot of people to make small mistakes because it continues to push the boundaries of their business and their growth opportunities without really penalizing them. So they encourage and empower their employees to explore these other business avenues and growth paths, knowing that they'll probably make small mistakes, but the payoff can be a lot greater. So that's the price that they pay for that growth, is small mistakes. As long as they're not big, it's fine. We're all trying to grow this business and focus on growth avenues. And the way you do that is by making small mistakes.
Excellent returns on capital.
Are you the largest infrastructure investor in the world?
Yeah, if not the largest, close to it. Yes.
Okay. For people that don't really understand infrastructure investing, can you explain what you actually do? Because historically, governments would build an airport, or governments would build a road or a bridge. What is it that you do with infrastructure investing that replaces the government but also enables you to make a profit?
So maybe most, to give you the broad spectrum of what infrastructure is, this is the backbone of the global economy. So anything behind the scenes that's provided to assist people move around, businesses operate. And so it's anything from telecom towers, data centers for cloud, toll roads, pipelines, transmission systems of electricity transmission lines, which sometimes you would see out there. So all of those things are the backbone of global infrastructure. And what's happened over the years is that governments can't afford, because they have so much debt, they can't afford to provide that infrastructure anymore. So that's moving into private hands. And because they're relatively consistent streams of income, we can leverage them quite successfully and therefore earn excellent returns on investment.
So for the average person who is listening to this, they might say, I assume, Well, if the private sector is moving in and they have to make a profit, things are going to be more expensive in infrastructure as I use those infrastructure assets. Is that true or
No,
not?
no, in fact, this is where it's great. Not to denigrate governments, but many times they're inefficient in operating things, and we can finance them more effectively. So we can run things better because we're from private enterprise often, but more importantly, we can leverage them off balance sheet to the government.
I want to make sure I understood what you said. You mean governments are not efficient all the time? Is that what you meant to say?
Yes.
That's hard to believe.
Well, and that's why, that is why, David, that the infrastructure moving into private hands is good for everybody. It's good because it brings the debt down in the countries. It's good for individuals because they often get a better service and often at a lower price. And it's going to continue to, the amount of money into private infrastructure is going to continue to grow and grow because of those two reasons.
So today,
So that was super important there. That might have been a little hard to grasp for some people, so I'm going to explain it. He's talking about infrastructure, so the backbone of economy. It's usually handled by governments, roads, toll booths, data centers, other, hydro dams, things like that. Like all that infrastructure, even cell towers, like all of that stuff is usually handled by governments, but it's more and more moving into the private sector because the government has too much debt. So governments have too much debt, so now they look to private equity and firms like Brookfield to handle building and financing these assets. Now, this private infrastructure benefits consumers because, like he said, private, equity and other private organizations generally are a lot more efficient than government, and they have better products or services for consumers, and like he said, often at a lower price. So it's kind of a win-win. The consumer gets a better product at a lower price, so that infrastructure asset at a lower price, and then it's a win for Brookfield as well because they generate significant returns on these investments. Now they can finance it, like I said, more effectively than the governments, earn this high rate of return on capital employed, and provide a better output for consumers. So that's the infrastructure. So that was Brookfield, kind of at a glance, Brookfield Corporation. So in summary, Brookfield is an alternative asset manager. They have a strong record of producing very strong annual returns for shareholders, like we saw over 30 years, 17%, over 20 years, 20%. And they have a very serious plan to continue doing this and moving forward and investing into these alternative cash flow producing assets. I've added Brookfield Corporation to my portfolio. It's a small holdings at about almost 6%. I plan to get it to probably 7%. As a valuation right now currently makes sense for me. But I encourage you to check out Brookfield Corporation. Go to their Brookfield site. It's just bn.brookfield.com. You can check out the corporation. You can also look at the investors page and see their different businesses if you want to invest in different businesses. I've just chosen to choose Brookfield Corporation because to me it's almost like holding an ETF. You get a stake in all of these other great businesses, and it kind of reminds me of like a mini Berkshire Hathaway. And Bruce Flatt, FYI, has been called Canada's Warren Buffett. So if that means anything to you, it's kind of a novelty, but he kind of to me has earned that title, producing those great returns over decades. So that's been Brookfield Corporation. I hope you enjoyed the content. Please like and subscribe if you like this type of content and these deep dives. And I hope you have a great day. Thank you. Bye. Please be reminded, I am not an investment advisor by any means. This content is merely for your educational or informational and entertaining purposes only. Please do your due diligence when investing. It is risky and you may lose money, and I am not liable for any investing decisions you may occur. Thank you so much. Hope you have a great day.